Interesting. Always a fun thing. Always a fun thing when the audio never really works. Um, and it might be an interesting video. So, my name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. If you've seen any of my previous videos, you know that I love strategy and targeted strategy. And that awareness is key because I'm going to keep sifting through these financial memes, or in this case, an email, using our investment strategies along with some everyday down to earth common sense. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. Like you might have just seen a cat walk across behind the shelf behind, or yep, there he is. Um, the cats are on the hunt tonight for some little moth they saw fluttering around the office, and they're being a little crazy. So, I am going to show our strategy of closed-end funds tonight because it relates to the email I'm going to talk about. And I am not a financial advisor. I am a financial strategist, really just a strategist in general. So please know that I'm not out to slander anyone. I'm interested in separating the good from the bad when it comes to advice and financial advice, because none of us want bad advice as we navigate our finances. So let's get into this. Now, I've said before, it was not a meme. I subscribe to several services. Uh, I'm on several different investment email chains. And one of them in particular, the Contrarian Outlook, talks about single stock investment, bonds, and talks also of closed end funds. I'm not going to talk about an email from them today. Of the other uh, email listservs I'm on, I subscribed to Seeking Alpha, hoping it would give me full access to an article, because on my Webull account, Webull posts related articles based upon, or I get they post articles based upon the funds we own. One of them at one point was critiqued by Seeking Alpha. I clicked on the link, and it popped up the article. Click on another link, and it popped up a headline, and then it blocked the article, like, "Hey, sign up for our service and then get access." And I did. And now it's, "Hey, you get these free emails with a headline." And the vast majority want me to pay for a service, but their strategy and mine are different. And they continue to look at closed end funds much like stocks or mutual funds, and not like closed end funds. So we differ in how to evaluate the system. We differ in how to use the system. But I enjoy reading the free content they have, but at the same time, it's interesting when we disagree. And in this case, I'm going to show you something. And I agree with their synopsis, but I also disagree with their advice. So let me show you what that means before I pull things up. So this is my email account. These are the emails I got from Seeking Alpha earlier this week. Um, and they're headlines, right? And I'm going to click, well, I already clicked on this one. That's the tab open. And then it's, they're advertising their service, what they offer. And when I click on this email, like continue reading, I get this. So this is me. Okay. It's $5 for the first month. I'm not going to pay for this. I pay for the Contrarian Outlook for a reason. I want the Contrarian Outlook advice. I want full access to the site. Uh, I want, I want their advice. Like, I like the free advice they give. I like the membership advice they give. So I pay $100, $99 a year for the Contrarian Outlook. Uh, it's the Contrarian Income Report, because the other membership services they offer don't suit my needs. And yes, that is the other little cat who gets himself into trouble all the time and who farted when he went past my head. Um, so this is a headline. NML is a closed-end fund, a very good midstream fund with a higher yield than its peers. Well, that's true, but that's not the whole story. Sounds really good, but is it something you should buy? Now, I'm going to give you my take. Whether you buy it or not is your decision. As it comes to us, we're not buying it right now, and I will explain exactly why. So this is the master list of closed-end funds. It's got every single fund currently in existence, and it has notes about all of them. It says membership because at some point, yes, I would like to make this a membership. As I scroll back over here, so a triple asterisk is a buy alert. So closed-end funds sell at discount. Now they can sell at premium as well, like this. So minus 4% plus 6%. And what that means, so if you're investing a dollar, if a dollar is break even, so when you invest a dollar into the fund, it costs you a dollar to invest. So at 0%, you're investing a dollar for every dollar you buy. If you buy something on discount, say 4% off, now you're spending 96 cents instead of a dollar. If you're buying something at a premium, now you're spending more for a dollar or more than a dollar for every dollar you invest. And that's important because, I mean, we all like discounts, right? Who doesn't want to pay? Who doesn't want to pay full price? But, or maybe who doesn't want a discount, right? Who wants to pay full price? Who wants to pay more for something than what it's worth? So the discount's important. I mean, it could be a crazy discount, but what's really the difference between 11% off and 4% off? Isn't this one automatically better? Yes and no, because now we're comparing one fund to another, and that's not exactly accurate. Now, yes, this fund has a higher discount than this one, but we should compare this discount to the historical data for the fund. So that's what the asterisks relate to. A buy alert is when the discount is double the historical discount and it's greater. We'll say greater than, but so it's greater than or double the historical discount and it's greater than the 5-year discount because funds do switch management. There are funds that when they were newly created sold for incredible premiums, and that which sounds amazing because when you own that now it's worth a lot more than you paid for it. But since 3, 4, 5 years after the fund, now it's just hovered at a 10% discount over the last 20 years. There are funds that change, right? And you can see how different management manages the system or how different economies impact the fund. So I think relating the current discount to the 5-year discount is good because we can see in the short history of things how it goes. But we also need to look at the grander scheme because if you buy a fund who's say greater than it's been the last 5 years, but then you take the bigger scope of things and see that it really has never changed, then you don't really know if you're getting a great deal or not. So we've scaled some things, and based on the funds we're interested in, we've added targets. And I have no idea who's texting me. Not important. So closed-end funds sell at discounts. And that discount to NAV is the discount to the net asset value. The net asset value is what the company's actually worth. For any number of reasons, they sell for discounts. Closed-end funds operate, like the name says and infers, in a closed system. When you consider supply and demand, pick the product that everybody picks on, oil. When oil is so plentiful that it actually dips into the negative, right? When supply is high, we can't use everything. So demand is high, but supply is even higher, then it brings down the cost of oil. When supply shrinks and demand goes up, it raises the cost of oil. And it also raises the cost of everything else because so much of our world is oil dependent and oil dependent in order to function properly. So many of our things, so many of the technology of today, so many of just the commonplace things we don't even think about are oil related. The stain for the wood behind me, oil related. The protective coating, the clear coat on those boards, oil related. The metal that holds it up, oil related. Your shoes, your fridge, your phone, the mouse, the laptop, your computer, pacemakers, crutches, um, not the copper wires, but the coating of copper wires. All of those things are oil-based products or oil derivatives. So when we cut oil supply, it doesn't just impact gas and oil. It impacts the supply and demand of everything. So in a closed system, there's only so many shares. That that principle doesn't exist inside the regular market. I pick on Coca-Cola a lot. Coca-Cola could at some point run out of shares. Doesn't sound likely, right? But if they ever ran out of shares, whatever the going rate of shares was that day, like it was, we'll say $60 a share. If they ran out of shares, they could simply pluck a share out of thin air, write you a share on a sticky note, and hand that to you. And that value would not impact the value of every other share. That's not true with closed-end funds. As funds become popular, so I can switch this order. There are funds that habitually sell for premiums. You're paying almost $2 for this instead of $1, right? That means that shares are in limited supply. It also means it's insanely popular. So it's hard to get a share. And when you get a share, someone's either selling a share uh, or maybe at some point they actually run out of shares and it's driving the price up. So it's not like they can just pluck a share out of thin air. Someone has to be willing to sell their share in order for you to buy it. And since it's so popular and things are in so much demand, they can make you pay whatever you want to pay for it. Which seems crazy because that's the value of the company, and that's what people are willing to pay for it, right? And now the converse side, that's the value of the company. That's currently what people are willing to pay for. And there's lots of reasons that impact that supply and demand. There's lots of reasons that impact that daily price. The market generally looks forward, regardless of how society and culture and everybody on those talk show circuit junkie stock market advice shows, they all seem to get around. They all seem to be experts in everything. When the wind shifts and it's now a great bond market or a great mutual fund market or a great uh, CD market or a great this market, everybody's an expert on everything. And where they're steering people, oh my gosh, this cat, excuse me. Good night. Like, good night. He's been a turd today. Like, good night. Um, as those people steer the market, they're steering the herd. They're steering the school of fish. They're steering the vast majority of people someplace that they want them to be. And normally the best place to be is where they're not steering the herd. So getting back to this. So the buy alert is a triple asterisk because the current discount of that single fund has a greater than or a double than the historical discount. And it's also greater than the 5-year discount. If it has two asterisks, it's what we're tracking. If it has one, or if it has two asterisks, it's a dollar cost average consideration based upon what we already own. And if it's one asterisk, it's something we're tracking. Everything in gray does not meet our parameters. Everything in blue is what we own. Everything in purple is recommended by somebody I read. So it looks like a bunch of jumbled up information. But when the pandemic or the plandemic hit and we had all this time, I spent my time, well, maybe not all the time, but I spent a huge chunk of time developing this list. I've spent the time to copy every single thing down. There's not an Excel file online for this. I made this one. It's not like I downloaded it. I got every single fund, the tickers, took notes, found out their dividend policy. Some are posted, some are not, and then made the spreadsheet to fit our needs. I update this. Everything color coded. So if it's blue, purple, or olive, it gets updated weekly, and then the whole thing gets updated every single month because I think it's important to update the entire system and then evaluate everything. So our current targets, uh, all the asterisks, and then I also dig into other funds. So if we scale this with the current discounts, and then we scale it based on target, and we own an ML. So I'm very familiar with the fund. Let's see. So we sort it in reverse. These are the funds. Oh, almost. These are the funds that are currently triple asterisk, right? For any number of reasons, but they're triple asterisk mainly because their current discount fits those parameters. These are dollar cost averaged, meaning in our system, they're worth less than what we bought them for. And single asterisk would be we're tracking for any number of reasons. Like this fund is more than what we bought it for. In ML, I'll get to IGR, FEI. FEI is higher than what we bought it for. IGR is less, but it doesn't actually meet the standard on a triple asterisk. USA, we want to sell, which sounds really bad. This is a bond fund we're going to keep. Same thing, it's currently at a premium. We don't pay premium. So if we get to NML, where are we? Here. So the article said it's a great fund. And let me stop my share for a second so I can pull up some other funds. So if we look at cefconnect.com, which I'll show you, and we look for NML, which I'll show you, and we also pull up NML's portfolio on Morningstar. They offer, I like CEF Connect. That's where I get the vast majority of my info. But if I want to dig a little bit deeper, I look at the portfolios on Morningstar. So if we pull up NML, share screen again. This is the information on CEF Connect. So you can see the current discount. Yes, it's got a really good discount. That little cat is freaking out about shadows right now. You can see how it compares to where it's been the rest of the year. It pays a 10% dividend monthly, and that's not all. Look at where they've gone. So you have the pandemic, they've scaled up the dividend. So if you bought it down here, like I did when it wasn't popular, then you're getting an insane dividend on your buy price. But look where else it's been. Now, will it get back to a 10 cents a share, 10 cents a share per month? I don't know. But prior to and currently, they're actually paying a better dividend than they were before the pandemic. When we get into the pricing, you can look at things long term. So the last 5 years is going to skew the data because it operated a much more significant discount than it did previously. And then you can get a basic look into their portfolio, which is why I like looking at Morningstar when I want more info. You can see how they're invested. Primarily energy, but also utilities. I like to call both energy infrastructure because you need both. It's not that large of a portfolio, right? It's no bonds. They own some other private stuff, but it's mostly energy infrastructure. can, mm, oops, there we go. If you really want individual stats, you can click over and find individual stats on all these other companies. So if we go back, so if we look at the existing metrics, so it's currently, I mean, this is the price as of Sunday. This is the information as of end of day yesterday. Not much changed, right? So we'll say the discount's 13 and a half, maybe 13%. If we look at that historically, that's close to the historic discount, close to double the historic discount, but it's not actually. It's not even greater than the 5-year average. Now that's good. I mean, that's great for the company. So when you buy things at a discount, especially when you buy things at double the discount, you have the net asset value here, then you have the discount. So as the company rearranges and changes their approach and they shrink that discount window, they increase the price. But they can also say if they add a dividend, they'll raise the stock price. And as the discount window closes, you're getting the profit or that increase of price on what you bought it for. Now, on our end of things, we don't flip. We have things that are earmarked for sale soon. We have things that are hold for a long term. We have funds marked for a lifetime. And I'll be transparent enough, and I do this anyway. But this is our portfolio. Um, the months of what we bought things, how much, you see all the metrics. When we come down to NML, I mean, regardless of the market, I have no plans to sell this fund. If it ever dipped below our average price and met the metrics, then yes, I would consider buying it. Currently, it's selling for $7 a share. Consider not crazy more, but more than what we bought it for, considerably more than what we bought it for. But where it sits now at $7 a share, you can see where it's been over the course of the last 3-ish years, 2.5 years. It's kind of on the higher end of things. I don't track dividend growth here. I really just track, well, I mean, I put in the dividend and then it automatically calculates for me. So if the dividend went to 0.6 cents a share, there we go. The spreadsheet would automatically adjust. Yeah. So this is our return since we bought it. This is our profit since we've bought it. This is the dividend growth since we bought it. If we wanted to look at dividend stuff in general, this is what it's projected to do for the year total, and then by those individual buy dates. And if we wanted to look long term, this is where we are so far. This is last year, the year before, and then total. So NML, getting back to the article, NML is a great closed-end fund. It is it's comparable to some, but it's better than its monthly peers. I mean, you're getting a great price. You're getting a fantastic dividend. It's just you're not getting the best buy window discount, right? So the historic discount's around 7%. That means if the discount, and it's close, I mean, you could argue that it's close. It's currently 13.4, which is closer than 13.3, right? But if it opened up to 14% or greater, then that meets our metric. And I'm pretty firm about our metrics on discount. These are the videos I do weekly about what stocks I'm looking at and why. And what we're looking at, what we've been targeting, it's the same metric. It's the same target system first. Then we look into overall yield. Goal has been 9% or above. The exception to that is this single fund, because we'd be foolish to ignore the fund with a 52% off discount. HFROs used to specialize are used to specialize in bonds and private bonds, and they seem to have transferred and transitioned their portfolio to real estate ahead of the interest rate cut, or at least what we all hope is the interest rate cut. Now, whether that happens in April or May or September, I don't know. But the Fed seems to be positioning to either keep rates the same or maybe cut rates at some point before the election cycle to say, hey, look how well we've managed the economy. Don't look into the fact that we screwed it all up, but look how well we've managed our own mistakes, right? And as soon as that interest rate actually cuts, then real estate's going to look really good. So I'd much rather get into real estate when it's unpopular and low than when it's higher and everybody's looking at it. So they transitioned their portfolio back in June at least. Uh, and then January, they announced a dividend cut. They cut their dividend in half, uh, which should help their overall value. Made it their fund got on, went unpopular. Like it was maybe $2 higher than that. And people went, wait, you cut your dividend? I'll just sell it. But I'm kind of I'm an opportune investor. The yield does not meet our 9% dividend requirement, but at the same time, I'm willing to break or at least loosen that requirement for that one fund. So we go by discount, we go by yield, and then lately we've been focusing on monthly payers because we want monthly consistent dividends. So when we look at other funds that pay monthly, FEI, that's a monthly dividend, but they haven't increased their dividend. It's been the same thing, like it's consistent, but as the price goes up, their dividend shrinks. So if we made the price $5, that dividend looks amazing, right? But they have not changed their dividend. It's been consistent. It's been nice, but I like funds that are willing to scale up their dividend because I like more money. FEI, yeah, consistent. But look, you have the pandemic and the dividend drops. And KYN that pays quarterly has raised their dividend significantly. GER, when it was a fund, they liquidated. They had the same thing, right? The pandemic hits, they scale back the dividend, and then they raised it consistently, then closed the fund for some reason. NML, you already saw that chart. Pandemic, decreased dividend, and they've scaled up the dividend. FEI has not, and that doesn't make sense to me. So we own it. It has great potential, but at the same time, it has not raised that dividend. Doesn't make sense. So NML pays an amazing dividend. It pays monthly, pays consistently, pays better now than it did before the pandemic. And that price has consistently gone up. But, right, because it sounds amazing, but you're not getting the full value or the best value for your money because that target number is not double the historical discount. So is it close? Yes, you can make the argument, right? Could you buy it? Sure. Your strategy is your strategy. On our end of things, our strategy is our strategy. I'm a pretty big stickler to that parameter because we want the absolute best deal possible and we want the absolute best value for our invested money. And that strategy has quite honestly taken time to develop. When we started investing in closed-end funds and I found the contrarian outlook, it was like interesting. I like their advice. Then I read a couple articles and went, this is cool, but I don't want the cherry pick data. So I took their advice and I modified it a little bit. We've never bought anything premium. We've always bought the discount, or we've always bought everything at discount. That being said, you'll notice we didn't always buy the best discount. If we bought USA Now, it would have to follow the parameters. And one, it doesn't meet the discount parameters. So the historical discount is at 5. That means the discount has to hit 10. Right now, it's more than the 5-year discount. right? But at the same time, USA pays an automatic dividend reinvestment, meaning they pay you the dividend and then they take the dividend back and invest it for you into the company. That doesn't suit my needs. Um, it's just, it looks like this. I mean, we don't own that many shares. They pay us a dividend and then they give us back partial shares. But that's not my style. I want dividend cash in hand so that I can invest that dividend where I want it invested. I can either stockpile dividends and wait to buy something, or I can't, I mean, like accrue dividends over a month and buy something, or I can accrue dividends or stockpile dividends over a couple months and then buy a larger batch of things. I also, it, when we initially started, we bought little pockets, little packets of shares. I don't do that anymore. I buy things in sets of 50 because I like the math. Um, and it also makes it easy to evaluate if we have enough money to buy something. Like we have $200 divided by 50, you get $4 a share. Is there anything $4 a share and under that I want to buy right now? Mm, maybe, but I'd rather wait and see how it plays out. So it gives me better parameters. So could you take Seeking Alpha's advice and buy NML? Sure, you'd get a nice dividend. You'd get a good discount. You'd get a great dividend. The price is higher than it's been in the last 3 years. That's good, right? I mean, that just speaks to the overall stability and need of the oil market. But are you getting the best deal for your money? It's close, but not quite. And that's where I differ with Seeking Alpha. Seeking Alpha sees this as, right, like it's on discount, 10% yield, sub 10 share price. Looks great. They don't look at the other stuff. And they tend to evaluate closed-end funds like you would evaluate anything else. And it's not even close to apples and bananas. It's like apples and pineapples. Uh, Sounds similar, but completely different. So just my take. Um, let's see. So see how to say this best. Your strategy is your strategy. My strategy is my strategy. My job is to educate and give you my take of things. My job is to sift through all the stuff and see if that sounds good, see if that is good, see if that aligns with our strategy, and then talk about that. And your job is to know your strategy and to sift through all the information like I do. And then you can take my advice and either chuck it in the garbage or consider it, like leave it on the table, like we do our mail, leave it on the table and think about it for a while. Or my suggestion is take advantage of it. Now, whether that means it helps you figure out if you want to buy something or if it helps you figure out if you want to wait on something, that's up to you because I'm not here to take your money and invest it for you. Would I like to market my membership to that database of funds and that database of information? Yes. Yes, I would. I would love to make that a membership, but at the same time, one, I'm not a financial advisor, so I cannot take your money to invest it for you. And two, that defeats my whole purpose. My job, my hope is that I teach you how to manage your portfolio, or at least teach you that you can manage your own portfolio. You don't need to pay somebody else who has a very different strategy than you. That probably has a much that probably has a outdated and ineffective strategy to manage your money. Because if they're not managing your money for you, and if they're not managing your money within the same strategy sphere, like if they're not following the principles that you want to be followed for the way you would invest your money, then they're investing your money according to their strategy, which doesn't help you much. So I want to teach you how to better sift through these financial memes. I want to teach you how to better sift through financial advice, including my own. You could watch this video and you'd be like, man, that guy's nuts. Or you could be like, huh, that's a different take. Or you can be like, oh, that's really good advice. Well, it doesn't matter which. Right now, I would like you to consider me better advice, but it matters for you based upon your strategy, right? Sift through the stuff. Really think about it. There are a ton of normally I make these videos on financial memes, and the vast majority of financial memes look pretty. But when you sit down and actually look at the meme, it is completely crap. Like there's a lot of people can beautify a turd, but when you get down to it, it's still just stinky data, still just stinky stuff. So should you buy NML? I leave the decision to you. For us, we're not, for the reasons I gave you. Should you do it? You need to figure out your own. So if you like the content, consider subscribing to my channel. Hit the like button, head over to Facebook, and join my group there called Navigate Your Finances. Remember, you're the captain of your ship. You make the financial decisions that direct your course. Okay, if you know where you are and you know where you're going, your ship's on that route, amazing. But if you want help, and if what I said makes no sense, then I talk about that over on Facebook. Wherever you are, I mean, I like metaphorical lingo. So wherever you are, that's your location on your map. If you envision a ship there, wherever you want to get to, those are your dreams. Then your job is to figure out how to get from where you are to where you want to get to. And your ship's course is dependent upon your decisions. So you have to think about stuff and you have to consider financial strategy and you have to figure out a way to get to where you want to be because that's not going to happen on its own. You can't think about stuff and just have it manifest, right? You have to think about stuff and plan it and strategically attack it and do the work. So if you want those dreams to happen, you're going to have to make them happen. And if you want help with that, come find me on Facebook. If you want more info on closed-end funds, by all means, comment on the video. And otherwise, this is Daniel Young signing off, and I will see y'all on another video, hopefully devoid of cats, or maybe you like the cats hanging out in the background and me having to deal with that. So either way, see y'all on another video. Bye-bye.